Please guys, do well to subscribe to my YouTube channel. If you've not subscribed, just click on the subscribe button you see here, and after you've done that, please turn on all notifications. Just click on notification bell so you get notified. Click on all so you get notified for every notification or every video here, every video I drop here on YouTube, guys. So please do this, subscribe, like my videos, and turn on notification bell so you get notified for every videos I drop. Alright guys, it's your boy MyFX again. So today we're going to be talking about the basic stuffs you need to know before trading Forex, and we're also going to be talking about how we earn from the Forex market. But let's just start with this. So guys, let's head over there and see the basic stuffs we should know before trading the Forex market. So at first, as a Forex trader, what you should know about the Forex market is that it is called the financial market. So when you hear the word financial, you should know that it's all about money. It's all about transactions. Okay, it's all about currencies. Like it's all about currencies. Yeah, both your local currency and other currencies. That is what the Forex market compromises of. And also, the Forex market has over $7 trillion to share to every Forex trader around the globe every day. The Forex market has $7 trillion every day to share around the globe to every Forex trader. Now, when I say share, doesn't mean it's a giveaway. So that is more reason why you have to watch this video so you can learn and know how to take your own share of the money from the Forex market. Okay, so number two thing you should know is that the Forex market is not a get rich quick scheme program. Okay, it's not a get rich quick scheme. Okay, it's not a get rich quick scheme. Something that you just come into the market and put your money and you make much money. So it's not an investment. Okay, the Forex market takes from you and also gives to you, but it is your intellect and also how good you are in trading that would show if the market will be giving more to you and be taking less from you, or the market will be taking more from you and giving less to you. Okay, so that is the goal we all have. The goal we have as a Forex trader is for the market to give more to us and take less from us. Okay, now number three thing you should know about the Forex market is this: the Forex market can be manipulative, and in the Forex market we trade against currency pairs. You can look here, we can see gold spot against, you can see gold spot slash US dollar, meaning you're trading gold against the US dollar. So we trade pairs against each other. Also in the Forex market, we trade mineral resources, we trade oil. In the Forex market, we trade gas. We also trade your entertainments like Netflix. We trade Netflix in the Forex market. Okay, so that is how the Forex market comprises of so many things. It's so wide, so broad. We also trade Tesla. You guys can know of Tesla. We trade Tesla in the Forex market. Those are under stocks. When you hear of GBP USD, USD JPY, EU, which is European dollar versus US dollar, those are currency pairs in the market. Those are Forex pairs in the market. Okay, that is just how the Forex market works. We trade on different currencies, different materials, different minerals, different companies. We also trade on companies. So these are the three things, or should I say 4 things you should know about the market. Okay, the fifth thing you should know about the market is this: the market would help you build your knowledge. Okay, the market will help you build your knowledge. This is the fifth thing you should know about the market. It will help you build your knowledge, help you be more confident, help you to be less scared, help you to face your fears. That's what the Forex market can do to you. Okay, that's what the market can do to you. Then the Forex market will help build you up, will help you reduce your ego. Okay, that is just what the Forex market can do in your life. It does so many things. You just have to face it and accept it. Okay, now I've talked about things and I've talked about what the Forex market is all about. Okay, let me talk about this stuff you're seeing. It is called candlesticks. We call them candlesticks in the Forex markets. The red and the green stuff you're seeing is called candlesticks. Now we are trading gold against US dollar, right? Which is gold spots versus the US dollar. So the green candle stands for gold. Let me just give it in that terms, that the green candle is for gold and why the red candle is for the US dollar. So the more power the green candle, the more power gold gets, or the more exchange rate gold gets, or the more gold goes higher, the more the green candle keeps on pushing up. The more gold falls and US dollar goes higher, the more the red candle keeps on pushing down. That's just how the forex market works. Same thing, let's say you're trading US dollar versus Canadian dollar. Okay, the more the US dollar goes up, the more the green candle goes up. But when the US dollar starts coming down and then the Canadian dollar has power, the more the red candle comes down also. That's just how the forex market works. Now let's head over to the next part of this. All right, since we are done for how the forex market works. Now we should know how we make money in the forex market. How do we make money in the forex market? All right, guys, now let me explain how we make money in the forex market. You can see this red candle going down, you can see the green candle moving up. So there's what we call buy and sell in the market. Sells whenever the red candle goes down, and then buys when the green candle goes up. Okay, so whenever you see a green candle pushing up, know that there are traders who are buying, and when you see the candle pushing down turning red, there are traders who are selling. So we sell when we see a red candle and we buy when we see a green candle. That is just how the forex market works. Let's just put it in that way, because it's a beginner session. That is how the forex market works. So let me say you have $1,000 at hand, or let me just say $1,000 at hand. Now let's use the forex market as a businessman, okay, as a business agent. Okay, a business agent comes to you and tells you that if you give him $1,000, that he's gonna make you $10,000. You now said, okay, I will give you $100 and see how much you can make from it. Then before I can give you $1,000. Now you then take out $100 and give to this business agent. He then trades on it and then gives you $1,000 in 1 week, or should I say $1,000 in an hour or 2 hours. You'll not be like, wow, this is lovely. All right, so I'll be giving you $200. Why? Because you had $1,000 before, and now he has made an extra $1,000 from your $100 you give to him, which is making your account now to be $2,000. Okay, let's take out the $100, making your account to be $1,900. Now you have a bigger money. You can now risk $200 to him. You give him $200, he goes and trades on it and makes $2,000 from it and brings back for you. You now have 3,000. Am I right? Yeah, you now have $3,700. Remember, you took out $200. Now your money is growing more big. You now say, okay, this time I want to give him $500 to go and trade for me to see if he can make $5,000. And then before you know, he lost that $500. So that is how the forex market works. Okay, we calculate these investments by lot size, and what we call lot size. In your $10, let's use $10 for example. Your $10 account, you use 0.01 lots and put into the market. That means you're giving the market $1. And now, due to your analysis as a forex trader, you're expecting the market to give you $10 back in maybe less than an hour or 2 hours. And then the market gives you that $10 as you expected. You now have what in your account? You now have $20, or you have $19, just as calculated before. That is how we trade the forex market. The next time that you want to trade, okay, I have $19, let me give the market $2. You now use 0.02 lot size. 0.01 signifies $1. Let's just put it that way. 0.02 signifies $2. 0.03 signifies $3. You now give the market 0.02 lot size. Okay, giving the market $2 to trade for you. The market now gives you another profit. That is just how the market works. Okay, in the forex market, you target big profits, small losses. Okay, give the market little and take much from the market. But if the market wants to take back from you, let it take little also. Okay, just imagine giving the market, you now have $1,000 in your account, and you then took out $500 to give to the market to make more, and the market takes the money away from you. You're not left with $500. You do not make any gain. But if you had given the market just $100, you'll be left with $900. Maybe the next time you would place a trade in the market, you will not be making, you might make back that money you lost and more of it. So I've just talked about risk management now. I just talked about risk management in the market. So as a forex trader, before you make money in the market, you need to know your risk appetite. You need to know what you can risk. Okay. Also in the forex market comes with emotions. There are some traders that once they lose money, in fact, every trader once you start trading, your first losses, your loss for a year, your a year loss, you start feeling bad about the market. You start feeling like you want to quit, you want to give up. The market always plays with our emotions. But the stronger you get, and how resistant you are, that would make you profitable in the forex market. Okay, if you can face it, face the dusties, knowing that yes, okay, I lost today, right, I'm going to make it tomorrow, you will go find the market. Okay, so I've just explained to you how we make money in the market. Okay, how we make money. Now let me explain to you again. Let me also explain to you some tools we use in making money in the market. Okay, we have the supply zone and the demand zone. What I mean by demand zone, look down here. You can see this zone down here is called a demand zone, or we can call it a support zone. It's called a demand or support zone. So we have a tool to mark out this zone in case you want to trade. So let's use those tools now to mark out our zones. We have the rectangular tool right here, which is used to mark out zones. Okay, so you mark out your demand zone. This is your demand zone. Just mark it out. Okay, as a trader, you just mark it out. Just mark it out. I don't have to start explaining how to mark out your zone, but just mark it out that know that this is a demand zone. Okay, demand or resistance, anyone you can think of, it is a demand or a resistance zone. Then the zone you see above, which is this one, this zone you see right here, is called a supply zone, or you can call it a resistance zone. Supply or resistance zone, that's what it's called. Now you can see that whenever the market moves red down to this demand zone, the market starts giving you green to the supply zone. Okay, that is how the market works. The market is all about supply and demand. That is why I told you it's an exchange stuff. People are exchanging gold to US dollar. People are exchanging US dollar to gold. It is called demand and supply. I'm demanding for gold to give you US dollar. You are now supplying the gold to me and taking my US dollar. That is how the market works. It is a vice versa. That is why we make money from it. Now, a trader waits for what? From the supply zone. Once the market hits the supply zone, a trader is looking for a sell. Once the market hits the demand zone, a trader is looking for a buy. Okay, so you can mark out supply and demand zones everywhere in the market. There are so many demand zones, there are so many supply zones right here in the market. But that is not just how it works. Because there are sometimes this market moving like this. All right, the market has hit the market is now from your demand zone. The market now went up to your supply zone, right? To this supply zone right here. Now you now be looking for a sell. You now be looking to sell the market and give the market $1 for him to make more for you. And then the market does what? The market goes down a little bit. Just like this, a little bit, and then breaks, and it destroys your supply zone. So now at this point now you made losses. That is how the forex market works. It's all about gains and losses. Okay, I hope that is clear. So now let me use a good tool in the market that can show you how to make money. Okay, I can show you how to make money. All right, so the best tool I use in this market as a beginner, you should get familiar with what we call Fibonacci retracement. So in your trading view, just click on the pencil sign you have right there. You're gonna see fib retracement. Just look here, you see where they wrote fib retracement. You just click on fib retracement. Now if you're expecting a sell on this market, please, if you're expecting a sell, if you're expecting to sell the market, mark your Fibonacci tool down from the recent low. This is a recent low we have here. Look at this market. This is a recent low. So you can mark it from your recent low to your recent high, if I should say so. To this recent high. This is a recent high. You can look at this place right here. Is a recent high. So mark it to your recent high. If you were expecting what? A sell on this market, okay, to your recent high. But if you're expecting a buy, you mark from the recent high to the recent low. Let me show you guys. Now I'm expecting a buy, so I mark from this recent high I have here down to my recent low I had here. Okay, why? I'm expecting a buy on the market, right? So that is just it. This is how to use your Fibonacci retracement tool. How to use your Fib retracements. So you're expecting a buy, right? So you mark it from recent high to recent low. If you're expecting a buy, then from recent low to recent high. Now, that is not our recent high. This is the recent high we have here. Let me show you. That is the recent, that's the recent high we have, because that's the high that the market just created. Okay, then to your recent low you had there, that's your recent low. Now, expecting markets to touch either on your 0.618 Fibonacci retracement zone, or touch on 0.05 zone, 0.5 zone, and then starts buying, start moving to the upside. But if it is a sell, you will expect the market to touch your 0.6% zone or your 0.5% zone and start moving to the downside. That is how you use the Fibonacci retracement tool. Okay, so let me show you guys now how I made quick money. I made quick money on this market. So let me show you guys how I made it on this market. I made quick money on this market. Let me show you guys. So let's mark this like this. Let's make it more broad. All right, so I use my Fibonacci retracement tool. Now let's just say this side of the trade of the market is not here. Let's just say we don't have this side. Let me just cover it. Okay, let's just say this side doesn't exist. This side is not existing. Like, this part of the market is not existing at this point. Like, it haven't started showing you this part. You only have this particular place. You only have this particular place like this now in the market. You are not seeing these other ones. Okay, let's just use it like that. Now look at this. Let's take it this way. So I take my Fibonacci tool. And draw from my recent low. The recent low the market created. This was the recent low, if I should say so. So since I'm expecting a sell, right? So I draw from this recent low. Let's just use this as an example. Up to this zone. Up to the zone. Up. Now, what are we waiting for? Waiting for markets to move into our 0.5% zone and start selling. Since we're waiting for a sell. So you can see that the market moved into the zone and started selling. But at the same time, on this sell, market gave you another lower, recent low. Let me show you. See that place? Is a recent low. Market gave you another recent low. So you now have to move your Fibonacci retracement to that recent low. So let's move our retracement tool to that recent low. Now move it to that recent low, to the body of the recent low. Good. Now you can see that once price did this, after markets came down, since you've marked it, you marked the Fibonacci, markets came down, okay, started consolidating, doing some ups and downs movement right here, consolidating, give another low here, then broke above these zones, above these consolidations. Market broke above these consolidations. Now you now know that, okay, since market has broken above this, all right, let me wait for market to get to my 0.5% zone or 0.6% zone. Then I will look for a sell on this market. Okay, so market, you can see that market now got to the 0.6% zone. So once the market got to this zone like this, a good trader will wait for a red candle to show up, because you're expecting a sell, so you should always deal with your red candles. But some traders, as soon as this market just hits this green, this their 0.6% as they are expecting, they will start selling. They will start opening their positions, their sell positions, and start selling. No, market can give you a fake out. Market can break this structure again. Market might not respect your Fibonacci zone and might break that structure and start moving to the upside. Now you will make loss on the market. Market might move to that upside to go touch this zone, and before it starts selling, then you now make loss. So you will wait for a red candle to create. So as for me, I caught this trade also. I waited for the red candle patiently. This red candle started creating, started consolidating from here before it started drawing down a little bit. Then I entered my trade. Okay, so I then set my limit. I then set my sell limit right here. I always set it on my Fibonacci zone. That is where I set it on that particular zone I'm expecting. My stop loss always 10 pips, if I should say so, or 15 pips. All right, 15 pips stop loss. Then take profits, either 550 pips or 100 pips. That is always my take profits. So you can see that markets got into that zone, right? Markets picked me up in my zone and then started what? Selling. Okay, started selling. But if you did not wait for that red candle and you had sold from here, you had picked up as soon as you just touched your zone, you started selling from there, your stop loss would have been a little bit close to that particular zone, and you would have seen that market would have taken you out before it started selling like this. So this is how it works, and this is how we catch sniper entries in the market. Okay, you guys must have heard of sniper entries. This is how we catch sniper entries in the market. Okay, so I've given you guys a brief explanation on how you can use your supply and demand zones, and also how you can use your fib retracement zones. Okay, fib retracement tool. I've given you guys clear explanation on that. So once market gets to your supply zone, don't forget to sell. Once you get to your demand zone, don't forget to buy. Okay, as a newbie trader, please, this which I'm telling you, practice it with the demo account. Practice it with a demo account. Don't practice it with your real account. I'm just telling you to buy, telling you to sell. It doesn't work that way. But at least if you can make this part of you, this Fibonacci retracement, a part of your trading plan, then market, you will do wonders in the market. Okay, so guys, I think that's all for today. Okay, let's anticipate for my next